The 2008 economic crisis is etched into modern financial history as the most devastating shockwave to rock the global economy since the Great Depression of 1929, proving that even the giants of Wall Street could crumble. Let's travel back to 2008, a year that forever changed modern finance. Ever wonder how the entire world economy could be brought to its knees in just a matter of weeks? This wasn't just a small downturn, it was the most severe global financial crisis since the Great Depression of the 1930s. But how did it happen? The story starts, perhaps surprisingly, in the American housing market. In the early 2000s, borrowing money was cheap in the United States, interest rates were low, and lending rules were relaxed. This made it incredibly easy for people to get home loans, even those with shaky credit histories, known as subprime mortgages. With so many people able to buy, housing demand and prices skyrocketed, creating a massive real estate bubble. It felt like the party would never end. But then, between 2004 and 2006, the U.S. Central Bank, the Federal Reserve, started to raise interest rates to control inflation. Suddenly, those easy mortgage payments weren't so easy anymore. People began defaulting on their loans. At the same time, the housing bubble popped and home prices started to fall. This created a perfect storm. Millions of homeowners owed more on their houses than they were worth and couldn't afford their monthly payments. A huge wave of foreclosures swept the nation, and this was just the beginning of the problem. So, why did a U.S. housing problem become a global catastrophe? The answer lies in a complex process called securitization. You see, banks didn't just hold onto these risky mortgages. Instead, they bundled thousands of them together into new, complicated financial products called mortgage-backed securities, or MBS, and even more complex ones called collateralized debt obligations, or CDOs. These financial products, packed with risky subprime loans, were often given top-tier AAA credit ratings by rating agencies who seriously misjudged the risk. Trusting these ratings, investors all over the world, from banks in London to pension funds in Tokyo, bought them up. Believing they were safe investments, investment banks in particular used huge amounts of borrowed money to gorge on these products. To make matters even more tangled, insurance giants like AIG sold policies called credit default swaps, or CDS, which were supposed to protect investors if these assets failed. This created a hidden, colossal mountain of risk spread across the entire global financial system. The value of all those MBS and CDOs suddenly evaporated. Panic set in. Banks had no idea how many of these toxic assets other banks were holding. Trust between financial institutions vanished overnight. Lending between banks, the lifeblood of the financial system, completely froze. A global liquidity crisis had begun. The breaking point came on September 15, 2008. The giant investment bank Lehman Brothers declared bankruptcy, the largest in U.S. history. This sent a shockwave of pure fear across the globe. The U.S. government had decided not to bail out Lehman, and this signaled to the world that no institution was too big to fail. The very next day, another giant, Merrill Lynch, was forced into a sale to Bank of America, and the government had to orchestrate a massive $182 billion bailout for the insurance company AIG. To prevent its collapse from taking down the whole system, the financial world was officially on the brink of total meltdown. This financial crash didn't stay in the world of high finance. It quickly spilled over into the real economy, affecting everyday people everywhere. Businesses couldn't get loans. Consumer confidence plummeted, and global trade slammed to a halt. Economies that had been booming, like the US and many in Europe, plunged into a deep recession, now known as the Great Recession. With demand collapsing, companies were forced into massive layoffs. Unemployment rates soared, causing immense hardship for millions of families. In response, governments and central banks around the world launched an unprecedented rescue effort. Central banks slashed interest rates to virtually zero and began radical policies like quantitative easing, essentially printing money to pump liquidity back into the system. Governments rolled out massive bailout packages to save their banks and stimulus programs to kickstart their economies. While necessary, these actions caused government debt levels to skyrocket. In the aftermath, a global push to reform financial regulations began. To ensure this would never happen again, in the U.S., the Dodd-Frank Act was passed, imposing stricter oversight on banks and creating new consumer protections. Internationally, new rules called Basel III were introduced, requiring banks to hold more capital as a buffer against losses. The 2008 crisis serves as a powerful reminder of how interconnected our world is, and how quickly greed and unchecked risk can lead to global disaster. Thank you for watching. If you found this explanation helpful, don't forget to like, share, and subscribe for more deep dives into the events that shape our world.